think Adam Smith, it's been a long time since I've read Smith, but I think Adam Smith believed capital was wealth. But Adam Smith believed that wealth was a function of how much labor you attached to something. So
Adam Smith was one of the proponents of the labor theory of value.
Labor theory of value.
So that would definitely fall in with the rest of the classical school, that the more labor there was, the more capital there was.
And the Austrians kind of got famous with the marginal revolution, which was kind of critiquing this classical labor theory of value with marginal utility. And marginal utility is very much a part of mainstream economics education. They recognize the Austrian contribution to marginal revolution.
Baker was one of 3 people that simultaneously discovered the theory of marginal utility. And it's actually the Austrian term marginal utility that we use. The other terms were discarded eventually by the economists. There was also, who was it? There was a British guy and a French guy. Jevons and Bell-Ross also discovered marginal utility.
You can elaborate on that? Or?
Yeah, I'll do a quick rundown of marginal utility, what it means. We can't get into too much, I don't think, on our time frame, but so, you know, if I have, you know, $1 million, each dollar is worth less to me than if I have, you know, $5. You know, if I have $5, I'm going to spend it on the things I want to buy most. If someone gives me another $5 and I have $10, I'm going to spend those next $5 on the things I want second most. If someone gives me $15, I'm going to spend the third $5 on what I want the third most. And so as the amount of money you have increases, the marginal utility of each unit of money decreases. And this is true with other things besides money as well. And this was the marginal revolution that happened in like the 1870s when economists started talking about this idea of marginal utility, and pretty much all of modern economics and Austrian economics has marginal utility at its foundation.
One of the keys is that the classical school had no concept of marginal utility. So if you've ever heard of the diamond water paradox, Adam Smith couldn't figure out why water was cheaper than diamonds, because water wasn't necessarily good for survival, whereas you didn't actually need diamonds. He was also a Calvinist, so he was using his religious views in there too. But well, it turns out that, you know, you trade things on the margin. On the margin, you generally have more water than you do diamonds, and so you're going to pay less for 1 more unit of water than you are for 1 more unit of diamonds. Now, if you were in a desert, if you were in the middle of the Sahara, and you have a diamond bracelet and no water, you're probably going to be willing to trade the diamond bracelet for the water. But we don't trade in units of all the goods. We trade in marginal units.
All right. I will get on to the Austrian theory of the business cycle. And this part will be a little bit dense, but I kind of don't want to cut any corners. I want to give the full theory. And, you know, if you want to do more research on it, there's a lot of fun layman explanations out there, different metaphors and such. But to go real deep into it, what we've got is the Hayekian triangle, which David talked about, is one thing we're going to keep in our mind during this. And another thing is going to be price fixing. And so real quick, I'll go through basic price fixing theory, and this is taught, you know, in every school of economics for basic things such as apples. I use in this example of what happens if the government tries fixing the price of apples. It could do it 2 ways. It could just decree that everyone can only, you know, pay $1.40 for apples. It could also start buying and selling apples in the market, you know, using tons of money doing this to fix the price of apples through open market operations. And it does this with farm commodities still today. It used to do a ton during the Roosevelt administration with trying to fix certain commodities through buying and selling. And even today it still does this with a lot of farm commodities. So we've got the Hayekian triangle over here and price fixing over here. And what do these 2 concepts have to do with each other? First of all, let's go through what happens with price fixing. And you know, you can have apples in your mind when we're doing this, but this is true of anything that the government fixes prices with. Is if the government wants to increase the price of something by buying and selling it, you know, if the price is $1, it just goes in and starts buying a bunch of them at, say, $1.40. what's this going to do? This is going to incentivize the production of this good. If it's apples, it's going to incentivize a lot of people to go, oh, you know, it wasn't profitable to produce apples at $1, but they're $1.40. Sure, you know, I'll turn my farm into an apple orchard instead of anything else. And it also obviously increases the price of apples, so the government's buying them at $1.40, so you'd have to be insane to, you know, sell your apples at $1.20, right? Because you could just sell them to the government for $1.40, and so this sets the market-wide price of apples at $1.40. Even like the private people who are selling them, who have nothing to do with the government, they're going to be selling at this new price the government has created by engaging in apple open market operations. And so, you know, what on earth does price fixing have to do with the Hayekian triangle? Well, the Fed fixes prices in the interest rate market. And so what it's buying and selling are bonds, treasury bills. But what it's doing is fixing interest rates. And you have to understand the relationship between bonds and interest rates is an inverse one. So as bond prices rise, interest rates decrease, and vice versa. And this is a basic accounting identity. You know, whatever, the money that's lent versus the money that's paid back, the difference between those two is the interest. And as you know, as the bond price is rising, so if the Fed goes in and buys bonds for more expensive than they currently are, then this lowers the spread between, you know, what the bond is and what's going to get paid back, and that lowers the interest rate. So that's just basic econ, is that as bond prices go up, interest rates go down. So when the Fed wants to fix the price of interest lower than it is, what does it do with bonds? Here's a quiz to see if you're paying attention.
So,
it buys them at higher than the previous rate, right? If it wants to lower the rate of interest, it starts buying bonds at higher than the previous rate, because as bonds go up, interest rates go down. Okay, so what the Fed is doing is fixing the price of bonds higher than they otherwise would be. And this is fundamentally no different than fixing the price of apples higher than it otherwise would be. So it is lowering interest rates by buying bonds at above their market level. As it's buying bonds above its market level, you know, when it's buying apples above its market level, what does this do to apple production? What does this do to the supply of apples? It increases them, right? Because it's more profitable to supply apples. More people are going to start selling apples if the price of apples goes up. So you've got more credit bubble is the result of artificially fixing the price of bonds high, or artificially fixing the price of interest low is the other way to think about it. But so it's, you know, if it starts buying apples at a ton of, you know, very expensive prices, it will create an apple bubble. When it starts buying bonds at very expensive prices, it causes a credit bubble, a bond bubble. And even though the Fed traditionally is only buying treasury bonds, although that's not true anymore, but if I was, you know, saying this 6 years ago, you'd say the Fed only buys treasury bonds, so how could it create a stock market bubble or a bond market bubble in non-treasury bonds? Well, if the Fed started fixing the price of apples too high or way above market levels, this would also fix the price of substitute goods to apples as well. You know, so if pears and apples are exactly identical in, you know, for all practical purposes, and suddenly the price of apples goes up to $1.40, well, suddenly people are going to start switching to pears, right? And there's going to be a huge increase in demand for pears, and the pear price is going to go up. So actually, substitute goods, the prices are affected by each other. So you know, screwing with bond prices screws with comparative investments. And when the Fed fixes the Fed Treasury interest rate, it also fixes interest rates across the economy. When it pushes that down, it pushes other interest rates besides the federal Treasury bond interest rates down. And it also, when there's this credit bubble, which in the context of the federal government would be a huge federal debt that's only possible at like 0% interest rates. Could you imagine if interest rates were 20% like they were in the early 80s, what, a $16 trillion debt? You know, what it would cost to finance that? That would be...
18 is it today?
Yeah.
Really?
18 today.
So 18 trillion. If we were paying, you know, a 20% interest rate on that, that's more money than we even taken in taxes, right? So it would be a debt crisis like Greece if interest rates were higher than zero, pretty much. So, you know, there's a credit bubble because of 0% rates, and there's also a non-government debt bubble as well. Because I was talking about the Fed lowers rates economy-wide, not just on treasury bonds. And so there's a credit bubble in the private banking sector, a government debt bubble, and then the stock bubble is kind of the other corollary of this. Stocks are really kind of a type of bond in some sense, and so they get screwed with like every other bond price.